Hi, this is Keith Schneider, CEO of MarketGauge.com, and it's April 24th edition of Market Outlook. So, let's take a look. We had a very nasty week. Markets were down substantially, or equity markets and commodity markets were down substantially this week. Let's take a look. First of all, one thing you can see here is that the Dow, which had actually moved outside of its 200-day moving average and actually had moved into an accumulation phase, by the end of the week, reversed order and is now back into a full bear phase. We've got the same scenario in the Qs, closing close to its recent lows. You've got a similar scenario in the SPY. We had attempted a breakout here earlier in the week and, of course, failed. And the same thing in IWM. We were looking like we were heading into a recovery phase, but that failed as well. So now the question is, what's going to happen next, obviously? And one of the things we always like to look at is how deeply oversold or overbought the market is, and looking at potential of mean reversion. So what we'd like to do is use our real motion indicator, which really is a measure of momentum, and put Bollinger Bands around it, which we have here. And one thing you can see is certainly in the Dow, even though on price we're outside of the lower Bollinger Band, not the case on real motion. In terms of IWM, similar type scenario, touching the lower end of the Bollinger on price, but real motion not there yet. So that is pretty much the situation across the board. So in terms of true oversold conditions, not quite there yet. And one thing that is certain, as you can see here in the Qs in the early part of the year, remaining oversold or outside the lower Bollinger Bands can persist. So to look for a potential mean reversion type scenario, I definitely want to look at moving outside the bands in both price and real motion, and then getting back in as a possible setup for a buy opportunity. At the moment, we're still in the thrust or the throes of a sell-off, which is not overdone quite yet. Okay, now moving on to a key intermarket relationship. If you look at the S&P versus utilities, that's been in a risk-off mode. That is also continuing here. So you can see here the ratio of the S&P to XLU definitely in favor of utilities. SPY is definitely in trouble when people move to utilities versus the S&P. That is definitely a risk-off type indicator, as utilities offer steady dividends and are not really, generally speaking, growth companies. Now, the other interesting takeaway from what's happening is, despite the fact that we're in risk off and utilities overall have been strong, when you're in this type of scenario where there's a sell-off just in general, it can affect all assets. So utilities were down quite a bit on Thursday and Friday. And so obviously you can see we're still in a bull phase in utilities, but stocks here, S&P, now in a bear phase. Quite a divergence of the two, and that definitely is telling us we're in a strong risk-off environment. Now, moving on to volume analysis, one thing that's clear is that this downtrend is definitely being confirmed by volume patterns. One thing you can see here, we've got 5 and 6 distribution days and no accumulation days in the Nasdaq 100. that's definitely a bearish situation. What we like to see is more accumulation days than distribution, and we've had none in the last 2 weeks. Quite a reversal from 3 weeks ago. And of course, just looking overall, what's interesting, you got the Nasdaq 100 down 18% year to date. That's pretty nasty. And of course, lots of pressure across the board. And over the last 5 days, the week here, we're down over 3-4, almost 4% in the Nasdaq over the last 5 trading days. So the one holdout that's actually doing quite a bit better is the Dow. Of course, they're more safety plays, value stocks, as opposed to the growth stocks that predominate the Nasdaq 100. So that's still down almost 7% on the year. So everything here under pressure. Just, of course, the value plays less so. Okay, now moving on to sectors, I think the thing to highlight, besides the fact that pretty much most of the sectors were down on the week, as you can see here, right? You had a couple of exceptions. The most interesting one is XLP, consumer staples. That was actually up. Again, that's a risk-off play. People need food. They need their basics. You need toilet paper, right? All the basics here. So consumer staples actually stabilizing on the week. And actually, year to date, again, the two basics here, consumer staples and, of course, utilities, actually positive on the year, with the S&P down over 10%. So, of course, risk-off plays continue to hold up quite a bit better than the rest of the market. Okay, so now moving on to market hotspots and more of a global macro picture. One thing that's pretty clear is that the sell-off took no prisoners here. So things that were hot, gold miners, right? Up 12% over the last 6 months. Metal and metal mining up 32%, and natural gas up 25%, all led down this week as well. So a bit of mean reversion in things that were actually trending up. And in terms of positive action and upside, right, risk-off type plays actually did well. So volatility, very, very strong, especially on Friday with the big sell-off. And of course, short foreign equities on the downside here as well. So net, the big picture, risk off, commodities led, and just overall, most assets sold off. All right, I hope this all helps. See you next week. Remember, keep an eye on the market setting up for some mean reversion, but our real motion indicators combined with price and using those Bollinger Bands will definitely give you an excellent heads up when that rally is ready or the market has sort of peaked on the downside. Okay, take care and see you next week.